Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Hello, everyone. Have you ever wondered how your income tax in Canada is actually calculated step by step? Well, you're in the right place. In this explainer, we're going to build that knowledge from the ground up. We'll start with Canada's dual tax system, then we'll look at the official calculation framework. After that, we'll get our hands dirty with the federal progressive tax brackets and a real-world example. We'll also clear up the confusion between marginal and effective tax rates, understand the role of tax credits, and finally, we'll see why all of this is so crucial for making smart financial decisions. Let's get started.
Okay, let's dive right in. The very first thing you have to understand about the Canadian income tax system is its dual structure. This is really the bedrock of everything else. It means you're not just paying tax to one government body, tax is collected by both the federal government and by your specific province or territory. And here's the key part. You can think of these as two parallel systems running at the same time. Both the federal government and your provincial government are looking at the exact same number, your taxable income, to figure out what you owe. Now, while the federal rates are the same for everyone across Canada, provincial rates can be quite different from one province to another, and that can really impact your final tax bill. So you might be wondering, how do these two systems actually come together? Well, it's not random at all. There's an official master framework, a kind of blueprint, that lays out the entire calculation. It guides you right from your total income all the way down to the final tax payable. And take a look at this. This is that official roadmap. I want you to notice the clear sections here. Part A is all about the federal tax. You calculate the gross tax and then you subtract your tax credits. Then Part B does the exact same thing, but for provincial and territorial tax. Finally, Part C just adds them together for your total tax liability. This structure is really the key to the whole process. Now, that official framework might look a little intimidating, but we can boil it down into a really straightforward three-step process. First, you calculate your gross federal tax using the tax brackets. We'll spend a lot of time on this part. Second, you subtract your tax credits to get your net federal tax. And third, you do the same for your provincial tax and add it all up. Simple as that. This brings us right to the heart of the matter. Federal income tax in Canada isn't just a single flat percentage. It uses what's called a progressive system, and really understanding this concept is everything. So what does progressive actually mean in this context? It's a simple but really powerful idea. As your income goes up, the tax rate that applies to your next dollar of income also goes up. I want you to picture it like you're filling up a series of buckets. You fill the first bucket at a low tax rate, and only when that one is completely full do you start pouring income into the next bucket, which has a slightly higher rate. These buckets are what we call tax brackets. And this right here, this is our rule book for the calculation. These are the official federal tax brackets for 2025. You can clearly see the different income ranges or buckets, and each one has its own tax rate. Notice how the rate climbs from 15% in the first bracket all the way up to 33% in the top one. That is the progressive system in action. Okay, theory is great, but the best way to really get this is to roll up our sleeves and walk through a practical example. So let's imagine a person with a taxable income of exactly $100,000. How do we apply those brackets to this income? We always start at the bottom with the very first bracket. And here's the most critical point. We do not apply one rate to the entire $100,000. Instead, we fill up each bracket one by one. The first bracket can hold up to $57,375, and every single dollar in that bracket gets taxed at 15%. So let's do the math on that. We take the full amount of that first bracket, $57,375, and we multiply it by 15%. That gives us a tax amount of $8,606. Let's just hold on to that number. It's the first piece of our puzzle. All right, we've dealt with the first chunk of income. Now, what about the rest of it? We've already accounted for the first $57,375, so we need to figure out how much of our $100,000 total income spills over into the second bracket. So that's just $100,000 minus the $57,375 we already taxed. That leaves us with $42,625 of income that hasn't been taxed yet, and this amount falls squarely into that second bracket where the tax rate is 20.5%. So we multiply that remaining income by 20.5%, which gives us a tax of $8,738. That's the tax on the second slice of our income. And now for the easy part. The final step in this core calculation is to simply add the tax amounts that we calculated from each of the brackets together. That's going to give us our total federal tax before we apply any credits. So we take our two figures, the $8,606 from the first bracket and the $8,738 from the second. We add them up and we get a total of $17,344. And there you have it. That is our gross federal tax, the foundational number for the rest of our calculation. Okay, now that we've nailed the mechanics of the calculation, we can dig into two of the most important and honestly, most often confused concepts in all of taxation, the marginal tax rate and the effective tax rate. The distinction here is simple, but it is absolutely critical. Your marginal rate tells you what happens next. It's the rate of tax you'll pay on any additional dollar you earn. Your effective rate, on the other hand, is looking backward. It's the blended or average rate that you paid on all of your income combined. Let's apply this to our $100,000 example. To find the effective tax rate, you simply take the total tax we calculated, that's $17,344, and you divide it by the total taxable income, which was $100,000. That gives us an average rate of 17.34%, or about 17%. It's the overall tax burden on the whole income. The marginal tax rate, however, is 20.5%. Now, why is that? It's because the very last dollar our taxpayer earned fell into that 20.5% bracket. So if they were to go out and earn one more dollar, that specific dollar would be taxed at 20.5%. So we have our gross federal tax number, but we're not quite finished. Remember that official framework we saw earlier? The next step is to apply tax credits, and these can significantly reduce the final tax you owe. Now, it's really important to know that tax credits are not the same thing as tax deductions. Deductions lower your taxable income before you calculate the tax, but a credit is a direct dollar-for-dollar reduction of the tax you actually owe. It's subtracted after the gross tax is calculated. For instance, the basic personal amount is a credit that almost everyone can claim. These credits are the government's way of implementing social and economic policies. So, why have we gone through all of this? What is the bottom line here? It all comes down to one simple reason. Understanding the difference between your tax rates is absolutely essential for making smart financial decisions. And this quote really says it all. When you're considering a new business venture, an investment, or even just picking up an overtime shift, your average tax rate doesn't really tell you what you need to know. The number you need to focus on, the one that truly dictates the financial outcome of that decision, is your marginal tax rate. And that brings us to the final thought I'd like to leave you with. Now that you can clearly distinguish between your average tax burden and the tax you'll pay on your next dollar, how will this knowledge influence the way you approach future financial opportunities? Knowing your marginal rate empowers you to accurately predict the after-tax return on your efforts, turning a complex calculation into a powerful tool for planning.